Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information. Contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good morning and welcome to the second day of Renaissance Capital Conference, ESG, a new focus for EM. My name is Alexander Bragansky. I'm Head of Oil and Gas Research at Renaissance Capital, and I would like to welcome you to our today's panel discussion, ESG and Energy Transition Challenge. We're very fortunate to have a distinguished panel of participants to discuss the topic of energy transition, which is becoming more and more relevant for countries, companies, and investors operating in the oil, gas, and petrochemical sectors across emerging and frontier markets. Without further delays, I would like to introduce our today's speakers. Kingsmill Bond, Equity Strategist for Carbon Tracker, Natasha Braginsky-Munier, Senior Fellow at FCLT Global, Board Member at Araday Capital, David Nichols, Assistant Portfolio Advisor for East Capital, Maxim Remchikov, Sustainable Development Director for Sibur, and Mikhail Skugart, ESG Reporting Senior Expert for MOL Group. Welcome to the panel. So what is energy transition? Energy transition refers to the shift from fossil-based systems of energy production and consumption, and that includes oil, natural gas, and coal, to renewable energy sources like wind and solar. It is a pathway towards achieving zero carbon status by the second half of this century. Challenges involved in this process are enormous, both on the part of incumbent energy producers, regulators, and investors. There are also significant differences in the willingness and abilities of individual countries to adopt energy transition targets. This is a particularly difficult issue for emerging markets, where many countries face other important health challenges and may not be in a position to adopt the same emission reduction targets as developed nations. Back in 2015, the United Nations adopted 17 Sustainable Development Goals as the blueprint to achieving a better and more sustainable future for all. Reducing poverty was goal number 1, eliminating hunger was goal number 2, getting access to affordable and clean energy, number 7, ensuring economic growth, goal number 8, building industries and infrastructures was goal number 9, and the climate action was goal number 13. All of these targets are equally important for the world, but their relative significance for individual countries can vary. Our analysis at Renaissance Capital shows that countries which are large exporters in volume terms, who are also low exporters of oil in per capita terms, often underperform in areas including education, poverty, and infrastructure. Energy transition would hit those countries the hardest and undermine their sustainable development prospects across the wide spectrum of UN goals. So as we move forward with this panel discussion, I would like to start with the first question to Kingsmill Bond. Is there a way to reconcile these varying agendas and ensure that the world is united along its energy transition pathway?
So, Alex, thank you very much, and thank you for the opportunity to speak. I work now for Carbon Tracker, which is a think tank that focuses on the implications of the energy transition for financial markets. And I should say that ESG in the US are about to peak. That's driven by superior and cheaper renewable energy technology, which just gets cheaper every year. And what that means is that fossil fuel demand has reached, if not a peak, at least a plateau. And after the plateau, inevitably comes the decline. And that in turn means lower prices and lower demand, which means disruption right across the fossil fuel system. That then in turn means it's an urgent necessity for fossil fuel companies and investors to reinvent themselves. And I think you asked me to, at the very start, to share my perspective a little bit before I plunge into a little bit more on your question. So if I can just share a couple of observations about this. So the third point I'll just make is that this shift that's taking place is a shift which has been completely missed by the incumbency. And this is a well-known chart of the expectations for new solar capacity, the IEA forecast versus reality. And reality on the red line is growing very quickly on an exponential growth curve. And the forecast of the incumbents, symbolized here by the IEA, and many other incumbent forecasters was that you would have linear growth. And it's a very, very similar story for coal, where the EIA has been continuously forecasting growth, and coal demand has been declining very rapidly. And the reason why I say all this stuff is not to beat up on the energy incumbency forecasters, but just to say, look, this is what happens when you get it wrong. The coal sector, for example, in the US went from, as you can see here, 500 to basically zero, and the energy sector has been derating as a share of the S&P index for years. And I wanted to bring out these 4 charts because I think it brings me to the key point we try and make at Carbon Tracker, which is that in the midst of this radical energy transition, ESG is important, and it's one of the factors, but it's only one of the factors. There's a really fundamental, real shift that's going on, and it's in the interest, consequently, of Russia to engage with reality, not to deny it, and to shift along with the rest of the world. And Alex, possibly to pick up on one point you made about the difficulty of emerging markets in making this shift, let's be clear, 80% of people live in countries that import fossil fuels. There are 100 times as much renewable energy sources as there are fossil fuels in the world. And consequently, it's highly likely that the emerging markets will shift to the renewables. So coming finally to your question in a bit more detail, look, I mean, the UN goals and the ESG targets are certainly not the driver of financial markets, with all due respect. The driver of financial markets is, as always, greed and fear. I think we need to recognize that you can't and you won't have to reconcile all of these different perspectives. All we have to do as investors is think about where the best returns lie. Thank you.
Thank you, Kingsmill. So countries will need to make a choice with respect to making their energy transition commitments, but challenge is also significant for corporates and investors. And in particular, there has emerged a strong negative bias towards investing in traditional energy-related companies, with many of the investment funds, particularly in Northern Europe, announcing plans to sell down their holdings in many of the world's polluters. So I have a question to Natasha. Is this the start of the trend, and is this the right trend? I mean, one can argue that by limiting their access to capital, such decisions make the energy transition more difficult for these companies.
Thank you very much for the question. Thanks for having me here. It's always a pleasure to be in the panel with Kingsmill and David, and we'll have a rich discussion about our views. And I want to kick it off by slightly disagreeing with Kingsmill. I don't think that the drivers in the market are greed and fear. The drivers are the short term versus the long term. And I think what's really happening now is that there's more focus on the long term and the financial and non-financial consequences of the actions that are taken by asset owners and asset managers. And that's a great thing. It's a great thing because it means that we're going to be taking into account not just returns on financial capital, but on other kinds of capital, which means nature, which means human capital, social capital, and it's much more difficult to integrate that into traditional analysis. So this is where ESG becomes so important, because it is part of that toolkit of extending the boundaries of traditional financial analysis, the kinds of things that I used to do as an analyst and portfolio manager, and include into that considerations that try to embrace the future uncertainty and include it into financial considerations without the kind of metrics that exist today. ESG is really early in having metrics consistent, and I know we can talk about that at greater length later. The most important things to keep in mind is that for asset owners and asset managers, the timeframes have gotten longer. Everyone has signed up to the principles of responsible investing, which means that we're aligned to the same long-term goals. We have to report annually on what we do to take steps forward. And region by region, the speed is different. So in Northern Europe, to your point, Sasha, there is definitely more pressure on divestment and capital allocation as a blunt instrument. The view is slightly different in other parts of the world, and certainly more different in US. My personal view is that you can't cancel energy. We need energy. We need it for economic growth. We need it for our transport. We need it for many countries that continue to rely on that as their sort of revenue model for the government, including the Russian Federation. And so we need to find pathways to reduce harm and to transform the existing giants. And often they are state-owned companies that are particularly important to these exporting countries. And we need to find better business models for them on a 20, 30-year horizon.
Thank you, Natasha. So David, how has East Capital adapted its investment process to reflect the climate goals and energy transition? So can you elaborate, please? Do you still invest in oil and gas stocks? How should investors reconcile climate targets with the objective of generating higher returns?
Yeah, sure. So thank you, and thank you for having me. Always interesting to speak. And I think you're right. You touch on this question of idea of divestment versus engagement is how we put it. And as you mentioned, a lot of our Scandinavian peers have now fully divested from oil and gas stocks, and we definitely understand that from an ethical perspective. And actually, most of our strategies already don't invest in fossil fuels. I think what we say, however, though, in Russia specifically, we really subscribe to this view that what Bill Gates said is that divestment to date has reduced about 0 tons of emissions. Whereas on the flip side, if you look at engagement, there's very strong evidence that actually investors can have a lot of positive influence in change. And you can look at things like what the Climate Action 100 initiative has achieved in Europe with companies like BP and Total. And we really believe there's room for this approach in Russia, especially for funds like us that sort of know the companies and speak Russian and things. And I think that one of the main points I really want to make is that actually Russian corporates are not sticking their head in the sand on this issue, right? And if you look at actually all these sort of implied emissions reductions announcements from our portfolio companies, they've already announced a sort of annual equivalent of 72 million tons of greenhouse gases in the sort of maximum year. And that's already equivalent to 120% of Swedish annual greenhouse gas emissions. So they are really doing a lot already. All right, and I particularly like to draw attention to Tatneft here, because they're the first integrated oil and gas company globally to sign up to the science-based target setting, which means they'll have net zero scope 1 to 3 emissions by 2050 with no nature-based solution. So I mean, I think it's a sign that Russia can and is adapting. And so, and if you take this graph and this graphic, and then what we see in our discussions, I mean, I think we do remain convinced that there is will and sort of know-how in these companies to carry on improving. Obviously what we see here isn't enough, but I think we're fairly confident that there is enough process to carry on investing. In terms of how we've changed our process, I think it's fairly simple. 5 to 10 years ago, it didn't really matter how much greenhouse gas emissions a steel producer produced, for example. I mean, unfortunately. But now it's incredibly material, and not just because it will have a significant impact on future cash flows, but then there's also the investor perception perspective. I'm very sure that any company really with worse ESG metrics and strategies than their peers will trade at lower valuations, and this valuation gap will increase. So we do a lot of work. We have proprietary scorecards, we have transition risk models, we do a lot of try to understand physical risks. And generally, we say we won't invest in fossil fuel producers unless we do have a constructive dialogue with them. In terms of your question on how we should reconcile climate targets with generating high returns, I mean, I think Kingsmill summarized it quite well. Climate targets and climate strategy more broadly isn't about sort of necessarily generating higher returns, or harming higher returns. But it's really the only way to avoid lower returns in the future, especially in a sort of mid to long term scenario. And how we think about it specifically depends a bit on the sector. But if you look at the energy sector, I think there's maybe 2 misconceptions. The first one is that the only solution is to go sort of full into becoming an energy company like BP. And the second one is that sort of net zero or Paris aligned scenario means zero oil demand. And that also isn't the case, but which obviously we think they've started to do, but there's a lot more to go.
If I can just add one thing, there's a lot more substantial discussions about the role and the magnitude of a carbon tax going forward. And I think that's very motivating for companies, for energy producers, obviously, when they consider their capital allocation and capital expenditure plans on sort of a 10, 20-year horizon. And it used to be that companies discussed very little sort of how that works into their strategic planning. And now that's gone really mainstream. And I think it's not surprising that it's companies in Northern Europe, and particularly in the Nordics, that have embraced this early on, because frankly, the risk of that regulatory change was much more apparent to them. And hence, that tangible sort of value extraction from their business was seen as a greater risk in a nearer time. Now that's becoming a time frame that's considered by oil companies in the US and globally. I think that there's a huge role for regulation and a carbon tax mechanism to sort of clear up people's confusion as to why certain companies are acting more rapidly than others, and hopefully will become even a stronger signal going forward.
Thank you for that, David and Natasha, and we certainly will move forward and talk about carbon tax during this panel. So I hope that we will get some more insight into that issue as well. Just before we do that, I wanted to give a word to the corporate side of the equation, and we're very fortunate today to have MOL Group with us attending this panel discussion. MOL Group has been at the forefront of the energy transition challenge as an energy company operating in emerging markets, but also located in the European Union, and therefore being subject to stricter regulatory requirements than most other emerging markets producers of oil and gas. MOL has been one of the first responders to the climate challenge, having formulated its energy strategy, the transition strategy, back in 2016. And also recently, MOL announced new climate reduction targets that are at the more ambitious end of the industry's range. So I would like to give a floor to Mikhail and ask him, how can corporates help investors navigate the world of energy transition, and what are the best reporting practices here?
All right, well, I hope you can hear me well. Thank you very much, Alexander, for the introduction. Also, thank you for inviting me to this event. I mean, as I said, we have had a strategy in place since 2016, which was recently updated last quarter, i.e. how MOL will successfully transition towards a low-carbon circular economy, which is even more pressing given the fact that we are, as you mentioned, within the European Union. And the European Union has a very strong ambition of reaching net zero by 2050. So of course we will have to adapt our business model as well as our activities and investment decisions as we transition to a low carbon world. Now, from a company's point of view, climate risk and the energy transition, they cut across all sectors of the economy. That is obvious. But the problem is that these manifest differently, not only from one industry to the next, but also even from company to company. So not all companies will be differently affected, or will be affected. It's just to a different degree and on the timing in that sense. So I think the challenge remains, how do you make sure you communicate that rightly, and how do you make sure you help investors accurately price the risk as we transition to a low carbon world. Now, we also feel that through conversation that there is an increasing understanding amongst capital markets and how to quantify and understand the impact of climate change on corporates. But the problem is, we all struggle a bit to quantify what are the impact of the transition of it and when it hits the different companies. And what makes it even more difficult, and this is where we come in, or my role comes in as the responsible for the ESG reporting, is that often corporates provide data that is incomparable using different reporting systems, which often confuses the markets and often can lead to misallocation of investments, etc., or miscalculations of risk. Furthermore, I think there's an increasing amount of disclosure from a corporate point of view on retroactive data, but there's limited disclosure on forward-looking risks, especially when it comes to transition risk, but also most importantly for physical risks associated with climate change. And I think what we have done in the past is make sure that to provide clear communication to the market as a corporate. How do we make sure that we mitigate risks associated with climate change, but only explain what are those risks, that's the most important part, but also how we capitalize on opportunities created by it. So in the sense, it goes back to our strategy. It's like not just making sure that we explain what are the risks we face, but also with the energy transition comes with a number of opportunities that we intend to capitalize on. So I think that's the most important part of it. Now, what we can do is that from a corporate point of view, what we do is you have to lean up against an already existing ESG reporting framework that will allow you to provide not only accurate but more comparable data, more comparable narrative to explain to the capital markets which may be familiar more with these reporting frameworks. But there's one thing important, that you should not lose the what I call the control of your strategic narrative. I mean, for us to explain to investors and capital markets the risks associated with the transition to a low carbon world, you have to come up with a key set of metrics that are decision useful, investment relevant for investors, i.e. so that they themselves don't rely on, say, ESG rating agencies or other third-party data in that sense, because often the best data will come from the company itself, especially if you make an effort to properly disclose it. But also two more things we have really put an emphasis on how we try to help capital markets in order to understand our strategic decisions is how carbon price plays a role in our investment decisions, and that's one thing, and also increased disclosure of greenhouse gas emissions, both not only retrospectively and not only our own, but also those of our value chain, but also going forward. What is the likely carbon trajectory that we face, giving our strategy, and how that plays within, let's say, a 1.5 degree scenario. So yeah, so in that sense, I mean, having had the right strategy helps, and then we've backed it up with a lot of reporting to make sure that the capital markets can increasingly or accurately price the risks that we are facing.
Thank you, Mikhail. So we already mentioned carbon pricing twice in this panel discussion, so that's, I think, a good time to move towards the regulatory changes. And that's certainly one of the key challenges of operating in Europe, is the most stringent regulatory requirements. Two hot topics for this year seem to be the details of this carbon border adjustment mechanism and the EU taxonomy rules, and I want to talk about both of them in this panel. A specific area of controversy has emerged about carbon border taxation and its relation to the free CO2 allowances in the European Union, and what is the impact on the broader international trade rules. And before we move to CBUR to talk about their experience with this and their strategy, I would like to ask Kingsmill about his views on whether this European carbon border adjustment mechanism can exist in isolation, so without it being implemented across a wider geography, and also can free quotas exist with the carbon border adjustment mechanism.
Brilliant, thank you, Alex. I should be brief in order to give the floor to Maxime, but look, I think this is actually, we must realize this is a slightly odd debate, and we need to look at the basic facts. Total carbon taxes, according to the World Bank, in 2019 were around $44 billion on about 40 billion tons of carbon dioxide. So $1 a ton, basically, is total global tax rate. And this is for a product with an externality cost of between $50 and $100 per ton, depending on who you ask. So the point simply is that the fossil fuel system consequently is imposing a massive cost on the rest of society, and that's been fine because it lasts forever. Higher taxes undoubtedly are coming. There's very good empirical evidence over the last 2 or 3 years of rising taxes all over the world. So therefore, when we talk about carbon border adjustment taxes, of course they're coming, because you can't have a carbon tax without a border adjustment tax. So they are definitely coming. One way or another. I mean, the fossil fuel industry no doubt will resist it, and incumbents will resist it as much as they can. But you simply cannot have a system, unless, of course, we all agree to tax fossil fuels equally, which is what I think the European Union wants to do as a kind of alternative. But the point to me is taxation is coming, and it's a little bit like building a house in a floodplain. This debate. You don't know how and when it's going to come, but there is a flood coming, and higher taxation is undoubtedly coming right across the park to a desperately undertaxed sector. Thank you, Alex.
Thank you, Kingsmill. So I think it's interesting to hear the CBUR opinion on the issue of the regulatory challenges in Europe. CBUR is an exporter to Europe and a big exporter of its end products to many other countries. So I wanted to ask Maxime, how does CBUR respond to the regulatory challenge in Europe? And as a participant in global trade with significant sales to China in particular, what will be the impact of European regulation on global trade flows? And how will CBUR's strategy change if a carbon border tax is introduced?
So from different angles, Alexander, actually, I do not have an answer to your question because what about CBAM mechanism? We understand that there is too much assumptions we should make to adjust our strategy to different scenarios, how it will work. But what we are doing is we see that as a polymer producer, it very looks like that our clients or market requirements to CO2, less CO2 or reduce CO2 footprint on your product is much more realistic and is much more, in our opinion, much more sensible. I think it looks like the same story in Europe with the recycled content in packaging, for example. So the pressure from the clients, the pressure from the market, in my opinion, our opinion, is also very strong. It may be, and maybe it is a little bit faster than the regulation is coming, or we understand how it will be, how it will look like. But what's important also is that we have. So I will ask just to put us. We decided to put some things on a slide, and it's actually this is the first time we show that. What we look at the carbon neutral strategy of Sibur. So what we have now, we have a certain metric of CO2 per ton in our ESG strategy, and it has the horizon of 2025. But if we look at all those, and also David showed the table with all Russian publicly listing companies and their greenhouse gas emissions reductions, on one slide. So we are not among them, and we do not have that type of goal in our strategy yet. But what we are thinking about is more thinking about carbon neutral growth. We think that it will probably be more adjustable also for marketing of our product, because we see the pressure on polymers, and we also understand that CO2 footprint is just another very important metric if we look at the competitive side of the material. If you compare that to aluminum, to glass, to paper. So that's why what we're trying to show here is that we have certain metrics today, but what we are looking in the future, and we look at carbon neutral growth and different types of how we could reduce our greenhouse gas emissions in terms of sequestration, in terms of carbon offsetting, using renewable energy, if we talk about scope 2. Also recycling. So for polymer producer, that's also part of a story. So we can reduce, so we diversify our feedstock as we are buying today our feedstock from Russia's oil and gas companies. And what we're doing with the recycling projects, we are diversifying our feedstock. We put, for example, what we are thinking about, we're not putting only recycled content in our feedstock, but also bio-based feedstock. And so this is the part of a diversification and a contribution to our product. And once again, we look at the carbon neutral growth and different parts of the equation, how we could do that, using renewable energy, using CCSU technologies, carbon offsetting, recycling. And there is definitely a bottleneck in terms of technology on the technological side. But as far as already today, we have been implementing the CO2 price for CO2 emission, CO2 in our investment projects. We also estimate the CO2 influence on our different also investment projects within the company. So it's a part of the agenda, but we are looking more, more on the market, more on our client side. And this, we believe that this will help us to prepare to different type of regulation that could emerge in the European Union. We also think that probably it won't be easy, definitely, because different markets, and Alexander, it was a fair thought that other global markets will be influenced by the European Union CBAM mechanism. But we couldn't say how that will. We estimate different types of risks in terms of climate risks, but we found ourselves being more and more prepared in terms of CO2 intensity on our products, and that will help us to deal with the different regulations that could come not only from the European market but from other markets to to which Cebur's products being exported.
Thank you, Maxim. David, can I ask you, how do you incorporate CO2 costs into your investment decisions? And more generally, how do you price in the growing climate-related regulatory risks?
Sure, yeah, happy to do so. And I think the first question is what carbon price you actually expect. And this is a very reasonable question because we don't really know, right? But the main point to start is probably not that many people know that one of the best commodities year to date actually is one in red, is this sort of below 2 degrees science-based scenario from the IEA. It obviously has exceptionally high carbon pricing. And then we have more of a base case, and we split that into exports and domestic sales. Basically, the assumption that there'll be a sort of lower carbon price than maybe the science would want for these. This is for a steel company by 2022, and then for Russian sales by 2030. And then once you've done that, it's actually relatively simple to sort of price that into your models, which we do. We know emissions, we know how much they export, we know any sort of emissions targets, intensity reduction targets, or absolute targets they have. And you can see here that the results are very striking. This shows the EBITDA of a large Russian steel company. Basically, we assume a sort of by 2023 we go to a mid-cycle EBITDA, which is green. And you can see just how big the impact on EBITDA is in the base case, and obviously even more extreme in the sort of below 2 degrees scenario. And the most impactful way of showing it, I think, is if you look at what the sort of DCF implied valuation from using these carbon prices in the model is. And for this company, the current market cap, as you can see here, 19 billion. If you look at the DCF without any carbon pricing, it's around 20 billion. So maybe you could argue looks attractive. But then if you assume even a base case carbon pricing, that the valuation drops straight away to 10 billion. So, I mean, this is a very powerful slide to show companies and directors. And I think it exactly goes in line with what Natasha was saying about how important it is for companies to start including this sort of scenario analysis into their sort of strategic planning and capital allocation. I would say, I mean, we see this more currently as a sort of illustrative exercise, and there's a lot of assumptions go to it. And I did show steel partly because it's the most affected sector, because we know that the carbon border tax is primarily focused on steel, aluminium, and concrete, and they have the highest scope 1 and 2 emissions intensity. So it wouldn't look this bad for the whole sort of Russian exporting economy, but I think you can see hopefully how we think and how significant the impact on valuation can be.
Thank you. I would like to switch gears a little bit and still staying on the subject of regulation, but move a little bit to the new regulation for investors, because there is also growing pressure on them to become more green. The new European Union requirement that underlying investors should be asked for their investment preferences by whoever is investing on their behalf, and that will take effect in the second half of 2021. And from the 10th of March this year, EU fund managers are now required to collect and report certain ESG data, and a part of that reporting is the classification of funds, so whether they have sustainable investment as their objective, or whether funds do not deem ESG risks to be relevant to the investment decision. And so I want to ask Natasha, how do fund managers deal with these growing regulatory pressures? Is it safe to assume that there will not be many funds in the future that do not take ESG risks seriously? And also somewhat related to that, there also seems to be a big geographical divide, and you mentioned that in your earlier remarks, that there is a big gap in terms of ESG priorities and policies between Europe, US, and other countries. And there are also differences in expectations in terms of timing. So how are investors dealing with these new regulatory pressures?
Well, I think the pressure is not only coming from regulators. You see more of that in Europe, but this movement started essentially with asset owners, with pension funds and foundations and sovereign wealth funds who have a very long-term investment horizons and who naturally see their responsibility and their stewardship of assets as being longer term than most other financial intermediaries. So I think it's a very holistic movement. It's not driven by solely regulation, but now regulation is catching up and essentially putting more parameters and more formalities around it, which I think is a good thing. We've struggled as an industry to agree on even the basic standards of reporting. We haven't talked about this yet, but I think it's very important that now that's changing. And I think that SASB, the Sustainable Accounting Standards Board, is becoming sort of that global tool to assess financial materiality and help companies report in a more standardized way. There are 4,000 signatories to the PRI now, and their AUM is over 110 trillion. And these are all asset managers and asset owners who annually self-report on how they go about integrating ESG in their investment decisions. So there's a real ecosystem now around doing this right. And TCFD, very helpfully, is also being deployed, and that'll help companies, investment managers and asset owners, to report their scenario analysis and their approach. So exactly what David just described, which is a very powerful tool, is just to say what if, and start thinking about the what ifs in their portfolios. That obviously affects how funds are sold, and that should be the case because we should know as savers and individual investors what we're buying. And it all comes down to a time frame. So your question was whether there'll still be funds that say they don't include ESG in their analysis. Well, you know what? If they're really short-term sort of market arbitrage funds, they very well could say that because ESG is a very long-tail thing. Sustainability is an outcome of a lot of ESG measures and a lot of decisions that are made by companies, and they manifest over time. So for good investors and for asset owners that take their stewardship to heart, of course, ESG will become central to a sustainable outcome. And I think that's good for the industry. We have many more tools now, both as investors and as companies making decisions on climate change, on how to best use ESG within their business model to make it happen. I think actually the case of Cibor and MOL is very illustrative. So, you know, MOL is one of the best companies on sustainability according to the Dow Jones Sustainable Index. They've done a lot to improve the rating. They have a great governance system as to who does what on the board and how it fits into the company. And they've done a lot to optimize their operations, whereas Cibor is taking the approach of, let's see what we do with our business model. How can we involve it better to fit our customers' needs, you know, and think of it as another leg to our growth strategy. So I think these are all really good things that are happening over this time horizon. And we all need to think of it as an extended time horizon.
Thank you. I agree. And there is another regulatory initiative in the EU this year that comes in the form of the EU taxonomy legislation. And many companies need to formulate the investment plans without yet knowing all the rules in terms of what qualifies as a sustainable investment and what doesn't. So MOL Group, as a company operating in the EU, will be directly affected by this new regulation. So I wanted to ask Mikhail, what will be the impacts of the EU taxonomy on MOL's future investment plans?
Yeah, well, thank you for that. So as you mentioned, yes, the EU taxonomy is currently now in place. It will be approved soon. Most of our operations, especially downstream, are within the EU. So therefore, we are hardly impacted by this. As I mentioned in the beginning, MOL Group has had a transformational strategy in place since 2016. I will be gradually transform our operations away from fuel refining into more petrochemicals, as well as we transform our fuel retail into more of our consumer services in that sense. So I think the EU taxonomy has come basically more as a validation of our strategy in the sense that we are moving into the right direction, given the fact that some of our main core activity within our transformational efforts is within the EU taxonomy. So I think, but from a corporate point of view, the EU taxonomy presents both a set of challenges as well as a set of opportunities. Now, the EU taxonomy has been in place or has been discussing for a while, but it has been delays, and that means from a practical point of view, we have much less time to consider it because we have to start reporting for next year. I mean, from how they will impact is that it does require significant time, as well as resources and expertise, to interpret the EU taxonomy as well as applying it. I think from a practical point of view, also a lot of investors, maybe also corporates, will have to remap even their stocks or activities directly into the NASA system so that we can align which ones fall under what under EU taxonomy. And that's the problem we face is that we would have liked to have had all this EU taxonomy in place much earlier, so we could have our reporting systems in place already by the 1st of January, but we couldn't. They came out today, so that means we're already in delay. Now, one of the impacts will be also that the EU taxonomy, if you look at it carefully, there's a lack of sector coverage, okay, which will present a number of application and reporting challenges. For example, our non-fuel retail, our consumer services is completely left out from the EU taxonomy. So how will that affect both from, currently will fall outside the scope, and therefore we cannot claim any revenue alignment with the EU taxonomy in that sense. So that kind of impacts a bit our investments. Also, what we see is that the complexity, but more importantly, the disclosure gaps between investors and corporates, they do remain a concern. Because as I understand, investors must comply by the end of this year, whereas we must comply at the beginning of next year in that sense. So you will see a transition period with a lot of heavy reliance on third-party data, etc., etc., etc. Okay. It also, the problem is that some of our lack of complete industry coverage means that some exclusion is there, especially for enabling activities. Okay, so therefore, a lot of our activities which may receive credit in terms of our enabling of other industries to meet their own targets won't be within the EU taxonomy. Okay, so now the impact ultimately will be that if we're not smart about it, funding can eventually dry up and or come at a higher cost, because MOL Group is currently in integrated oil and gas, and if you look at our activities, upstream, refining, gas midstream, logistics, fuel retail, they fall outside the EU taxonomy. And then there are a number of non-core areas which we're heavily investing in and that fall inside. And the big question is for us, the petrochemicals. Okay, now there are some opportunities, and this is the good thing about it, in the sense that there'll be greater transparency both for corporate activities as well as EU ESG fund investment. So we will have a consistent framework, comparable data, where we can all compare either revenue, OPEX, CAPEX, etc., etc. So that's it's a big plus. It also helps us on capital markets assess more sustainable activities better and to price environmental externalities in that sense. I think, but what really helped for us is that it'll probably expand the investment universe in the sense that most of the EU taxonomy has been designed in a way to urge or encourage highly emitting industries to decarbonize, such as steel, chemicals like ours in that sense. These are often what we see underweight in these ESG funds. But now the fact that some of them, our activities can qualify on the EU taxonomy means we may potentially become investable under ESG funds in that sense. So I think that's a reward. And finally, the opposite will also take place as we look through our activities. The EU taxonomy for us will mean that the more we invest in activities that are eligible under the EU taxonomy, as well as fall within or align with the EU taxonomy, I think what we could see in the future is that we will see higher multiples as well as the lower cost of capital, potentially even easier access to capital, especially when it comes to debt, because debt we think is the easiest source of capital claim alignment with the EU taxonomy in that sense. So I think because they can easily, the use of those debt proceeds can be easily specified for aligned projects. What we have done in our new strategy is that we have set a target that, and this is the key indicator, CAPEX will be in the key indicator. I mean, we have to report revenues, CAPEX and OPEX, but we think that the key indicator that the capital markets should pay attention to, at least in our case, is CAPEX, because that's more of a proxy for future revenue and earning streams in that sense. And if you look at the CAPEX from last year, I think around 40% of it went for petrochemicals in that sense. And we have had to set a target for 50% EU taxonomy aligned CAPEX by 2030 and 100% EU taxonomy aligned CAPEX by 2050, and that's in with the EU. So in that sense, our investment decisions came before the EU taxonomy. So in kind of way, our idea was validated, but what it impacts for us is that we will see a reallocation of capital, not only from the capital markets, but also for ourselves, and that more and more of our capital expenditures will go through not only our petrochemical businesses, which is there for within the EU taxonomy, but a range of other non-core businesses which will grow in the future, like recycling or e-mobility or hydrogen, etc., etc. So they will heavily influence the plans, and we're already working internally to make sure that every capital allocation decision comes with a full overview as to whether this fits or doesn't fit, or is aligned or is not aligned with the EU taxonomy.
Thank you, Mikhail. So there are other countries around the world that also introducing their own taxonomy regulation. I think in Russia, in particular, they want to introduce taxonomy regulations this year. And so I wanted to ask Maxim how, if he knows how the Russian approach will differ from the EU taxonomy rules, and also how will the SIBUR align its future investment plans with the sustainability regulations?
Thank you, Alex. Frankly speaking, I do not know the details, how it will look like. I know just only the basics that been discussed for a certain time. But what I believe in is that Russian taxonomy rules will give more incentives to Russian companies to stay competitive on the global market, on the export market. That's the idea, I think. And I do believe that this is that's great that this is also the part of the agenda for financial regulations. But I think that Russia's I think main challenge in this area is the access to capital, is the access to long-term investments that could lead to certain competitive advantages of Russian companies, Russian products on the global markets. And in this philosophy, I believe in, for example, if we consider polymer or chemical companies, we believe that, for example, it will give incentives to develop chemical recycling of plastic waste, for example, because on one side, this is the contribution to solve the waste problem in Russia. And I should remember to all the speakers that the waste management system in Russia, for example, is far behind of what you have in, for example, in the European Union. We do not have separate collection of waste for many years. It's been just implemented a year and a half ago, and it is very big challenge for the country. So I think that given incentive to companies to recycle more plastic waste, for example, and giving back the original feedstock, and that's what I also mentioned when your first question was, is that we are diversifying our feedstock, and I think in that case it will work. So Russia's taxonomy will contribute to Russian business, to Russian companies' export success, and thus lead to a grow in taxes, and grow in revenue that could lead to a more taxes collected. So I believe in that spirit of Russian taxation. That's the first question of yours. The second one, how SIBUR will align. I believe that what we are looking at already right now, and I also mentioned that we put these metrics in our investment planning. That was a very important step to consider the CO2, so the carbon tax in our investment model, to consider the consequences for certain entities in Russian Federation where we do our investment projects. This is the important part of the whole investment process. But at the same time, what we are thinking about as a company is that we want to consider all ESG related investment projects as part of the contribution to the EBITDA, and that's definitely should be at this historically high level. If we consider SIBUR, if we consider, for example, EBITDA margin, that's why we are looking at all ESG related projects in this sense. It should be at this still contribute to a high level of EBITDA margin, and
with a view to have a much greener long-term infrastructure sort of network around the country. And that's new for the US. So that's kind of a shift towards thinking about holistically a footprint that's long-term positive, but maybe in the short term will be more carbon intensive. There's also a greater focus on social justice and racial equity, which is not surprising given the headline news. And the S in ESG in the US has been probably the biggest pain point for companies and for investors over the last couple of years. As much as in Europe, that's not really a contentious issue. not to the same extent. And so in Europe, there's much more consensus that the pain point is environmental and also governance, and to ensure that there is transparency and accountability for what gets measured, who gets paid, and how those link up. And you see that now in the proxy season as being a very important item. And in Asia, it's a bit of a mix. There is a bigger focus on governance because it had been absent before. And there is a real need to diversify energy sources and resources. And I think that fits well into the long-term considerations of sustainable energy policies.
Thank you, Natasha. I wanted to come back to Kingsmill at one of his earlier points. So it is quite obvious that large energy exporting countries such as Russia and the Middle East will be at the losing end of the energy transition process. But some of these countries could accelerate the transition themselves, while others may choose to become the last man standing and delay the transition for as long as possible, with an idea of monetizing as much remaining reserves as possible. So I wanted to ask Kingsmill if he thinks it pays to wait for these countries, or should they go ahead, full speed?
So paying to wait is another one of these very dangerous, damaging, false solutions. It's right up there with the idea that CCS is going to allow you to continue to pollute with impunity, that demand remains high and therefore you're fine, and that transitions always take forever. I mean, this is a rapid energy transition. Paying to wait just means you're even further behind. And I think that actually raises a wider question. What should Russia be doing now under these circumstances? And let's be clear, Saudi Arabia, UAE, Canada, other countries in a similar position are actually changing quite quickly. And they've got really quite serious plans to shift their strategy for the for this new energy world that we're entering into. And Russia, dare I say it, is rather behind on this. So normally there's a kind of choice here. People talk about three choices: do nothing, or you wait, or you change. But actually, the first two are false choices. There's only one option, which is you have to change. Russia actually is blessed with these fantastic natural resources of solar and wind and land. It's blessed with huge an industrial base and people, and it could lead in a lot of these new energy technologies. It can lead the world into this new energy system, and therefore it should be significantly reducing capital expenditure on the wasted, stranded assets of the fossil fuel system. Do not develop Siberia and the far north. It will be a complete waste of money.
Yes, thank you, Kingsmill. So, David, I wanted to ask your view on the same subject as well, and also, I think related to that, you mentioned in your previous remarks the physical risks related to the energy transition. So we also the situation with Norilsk nickel, there is melting of the permafrost, the forest fires, and other events like that. So how do you factor that into your assessment process?
Yeah, sure. I mean, eventually that Russia has. So I think I'd say it's at the moment too early to really say anything definitively, but definitely something to watch out on, and something that I know all the companies we speak to, especially the gas ones, are spending a lot of focus on. So that's one area where they can sort of, I think, combine the old and the new, so to speak. If you combine, sort of standard hydrogen with carbon capture, which Russia also has the potential to do. So I think that's one interesting area that could sort of combine the two. But if you look at physical risk, I think it's a really interesting question, one that we generally think is not being taken seriously enough, which is odd because there's actually much in sort of the very short term. It's actually a much bigger risk, right? You can look at what happened to Norilsk last year as a good example of that, and just to. I think in terms of how we evaluate it, it's actually very hard to do systematically. But what we can do is just look at quite how alarmingly fast Russia is warming up. It was 38 degrees last year in the summer in the Arctic Circle in Russia, and you can see here on this map that actually in terms of the anomalous temperature of how hot it was last year, we're in many places we're above 8 degrees higher than the average for the last from 2013 to 18. So I mean, we see this as a very serious risk, but also we see it as something that's actually hard to systematically analyze. What we do is we speak to, I mean, whenever we speak to companies or boards about this, I mean, really try to understand exactly what they're doing about it and how confident they are, how they've done their again, scenario analysis. So what would you do? How would your infrastructure react if there was to be these sort of temperature anomalies going forward for the next 10 years? You know, what would happen to the permafrost? How would your infrastructure be? And I think obviously, I mean, the Norilsk incident has accelerated it, but the oil and gas companies are aware of this. I mean, I think Novatek's Yamal is a good example of something that's been built with this in mind. But it's definitely something that I think should remain very much at the top of investors and particularly companies' agendas who operate in these sort of areas, which is 15% of Russian oil, 80% of gas, and a lot of the mining. So it remains very significant for the Russian market.
Thank you. It's interesting that you mentioned hydrogen. There are other, more environmentally sources of fuel that could be produced from natural gas, so ammonia and methanol, among others. And so I wanted to ask Maxim about Sibur plans, potentially with respect to the conversion of natural gas output into the greener fuels. Sibur is currently has a lot of excess feedstock, which it sells to the third parties. What is the potential here for Sibur, and what is the potential timeline for this transition?
I believe that this is the timeline, probably 10 to 15 years. But what I think for us, it's more about how we make our business model. So we, after launching Zapsib and last year, so this is our biggest capital expenditure for the last 5 years, with almost $9 billion of capital expenditure, capital investment, and we are now preparing a new project at Amur region with almost the same capex, and that means that more feedstock will be capitally consumed by our new production line. So in my view, first, I think that this is a rather long horizon, like 10 to 15 years, I believe. But more importantly, we are as a company looking at how that could contribute to our CO2 reduction, how that could contribute to our product being less carbon intensive. And as far as we have that business model that is more resilient to different price hikes in different segments, for example, in gas processing or in petrochemicals or different intermediary products, it's more about how we will, what the proportion will be in these different segments. So if we're talking about CO2 intensity, it's more about how this could contribute to our less carbon intensive product. That's I think the overall logic, and how we as a company and energy efficiency and all these things. So that's why. So my perception, I think, more about is that we will look at how that could contribute to our less CO2 incentive products, because we believe that we see, and I could compare it, for example, with the recycling story from as a global demand from our clients, is that this is as a part of a solution. If we want to be if we want to stay and develop our clients and stay on the same markets we are now. That's why we're looking more in this area.
Thank you. For MOL Group, the energy transition comes down to less production of motor fuels and more petrochemical output. So, Mikhail, staying on the subject of recycling, how does MOL integrate plastic recycling into its strategy?
Yes, so thank you very much for that. So, as you correctly mentioned, the core of our strategy is moving away from the production of fuels to more towards transforming ourselves to the production or manufacturing of petrochemicals or plastics for industrial purposes in that sense. So at the beginning in 2016, I mean, the major focus for us back then was making sure that there's a petrochemical we call product diversification, i.e. the extension of the value chain, by manufacturing new lines, i.e. whether it's propylene glycol, polyurethanes, or synthetic rubber, etc., etc., etc. But with a new strategy, there's also new focus. Instead of prioritizing the petrochemical product diversification, we're prioritizing the diversification of the feedstock itself by integrating different types of waste streams into the future operations of the company, whether it's bio, industrial, municipal waste, etc., etc. So we will see that a lot of the output is not so much based on virgin feedstock, but it's also an increasing amount of it is based on recycled feedstock. So I think when you look at in the future on this, what this means from an environmental point of view, what's the footprint of the group, you will see as we invest more and more into our petrochemical facilities, our scope 1 emissions are likely to increase, everything else being equal. If there are no energy efficiency measures, no use of renewables, etc., because petrochemicals are by nature a more energy intensive activity. On the other side is that means that as we withdraw from the production of fuels, and that means that our scope 3 will decrease substantially. And as you can see today, 90% of our total footprint today comes from scope 3, and 90% of that scope 3 comes from the selling of the diesel and gasoline. So in that sense, our scope 1 is likely to increase in the future, but our scope 3 will substantially reduce because we focus more on the production of plastics. And as you know, plastics, they do retain the CO2. And that says even the plastic footprint, which we actually starting to report last year, will be improved because there's 3 ways you can dispose of a plastic. You can landfill it, you can burn it, or you can recycle it. And so a lot more is being recycled in the EU, a lot less is being burned, a lot less is being landfilled. That means it goes back into circulation. So even our plastic footprint is likely to be reduced as a result. So in our future investment plans, the diversification of the feedstock plays a much more important role than it has in the future and it has in the past. That with the positive outcome that our overall footprint from not just from our own emissions, but our entire value chain will decrease as a result.
Thank you, Mikael. So as we heard today, companies respond differently to the challenges of ESG investing and energy transition. There are many different climate and reporting initiatives, a plethora of ESG rating agencies, and varying regulatory requirements around the world. Natasha, I wanted to ask you, for somebody who's been involved in the ESG world for a long time, is there a standard for good corporate response in relation to ESG? For example, we have seen some corporates have created ESG committees at the board level. So if there was one piece of advice that you would give to the corporate world, what will that be?
Well, my one piece of advice would be strategic about ESG. It means different things to different companies, and it has different implications depending on where you are geographically. For many European companies, ESG right now is a lot about compliance, and it's a lot about sort of mitigating risk, current and future, to their operations. But that's not all that it's about. I think it's very compelling what Mol and Sibor have said today in our discussion as to how much the business model can evolve and how much strategically it can benefit their growth opportunities with different kinds of customers and potentially, shift the business to a cleaner but also a more higher growth path. There are very different models in terms of governance. Some companies do have oversight that's specific to a board committee. Others have a chief sustainability officer that's implanted in the executive team. There is no right answer, but it has to be aligned strategically to what the business is, where it operates, and where its customers are.
Thank you very much. Yeah.
Yeah, if I could just add on that, I think particularly with regard to your question on ESG ratings, obviously it's great that we have this tool, but what we've seen in companies that it really kind of creates this idea that ESG is about just waves and waves of disclosure, and we have companies telling us they need to have 600 data points disclosed in order to increase their ratings in X or Y area, or, a different IR of a steel company say he's making policies just to get higher ratings in ESG, different ESG ratings agencies. And I'd really stress what Natasha said is that it's it's not just about disclosure. I mean, disclosure is great, and having the data is a great place to start, but it's much more about the governance and the sort of how ESG is integrated into your strategy and your capital allocation process, rather than just how much data you disclose.
Thank you. Thank you, David. So as we come to the end of this discussion and before we break up, I would like to ask everyone the same question about what they think will happen to the energy prices in the coming years as we go through the process of energy transition. The way I see it, there are broadly two schools of thought here. The one view is that there are high organic decline rates in the oil and gas space, and as capital gets allocated away from this area, the prices could actually go up. The second view is that the companies will start producing as much as they can to monetize all the remaining resources, and so actually that could result in much lower oil and gas prices in the coming years. So can I just ask every panelist to share their views on this subject, and maybe we start with you, Kingsmill.
Sure. Thanks, Alex. I think actually I can try and reconcile your two perspectives. The first perspective that the industry will be bailed out by decline rates is a kind of old thinking of a time when there was no competition. And the reality is that the entire fossil fuel system is now facing competition right across the board from technologies which are cheaper, cleaner, faster, and local, and which are on very, very powerful technology decline rates. A new paper came out, for example, 2 days ago by the Smith School in Oxford, demonstrating that the cost of these technologies is going to continue to fall. And that means the absolutely most profound point is that you're going to have a deflationary price environment for all energy for the future. And companies will have to accommodate to that framework if they're going to survive. So to answer your question, lower prices for sure, but with cyclicality and spikes, obviously.
Thank you. Natasha?
With all due respect, I'm not even sure it matters. I don't know the right answer in the short term, but in the long term, I don't think it matters. Because what's going to really shift things is the regulatory decisions about carbon pricing, carbon tax, and sort of the redistribution of profits and risk from this sector and from our, sort of socioeconomic systems. And secondly, it's also consumer preferences. And to the extent that the electrification of vehicles and transport is happening, and that's sort of a secular shift, it will affect demand. It'll affect the way people think about how they use energy. So, in the short term, it almost doesn't matter what happens to energy prices, because I think the long-term trajectory is towards the obsolescence of fossil fuel and found better things to use.
David?
Yeah, I absolutely agree. I mean, I think short term, we could definitely see some upward pressure, right? As this sort of last hurrah oil rally, but I absolutely agree that in the medium term, it's very hard to see sort of strong oil prices. It's actually the sort of the renewables theme is very well understood in terms of pricing, but even nowadays it's actually cheaper to buy and run an electric car in China than it is a diesel car. And I think that the standard narrative is that EM, petrol demand or oil demand will sort of maintain high oil prices going forward. I think that's now really starting to come into question if you look at the sort of explosion of electronic vehicles in places like China and soon to be India. So yeah, I'd agree with closer to probably what Kingsmill said.
Thank you. So what's the view of the corporate? Maxim?
I most likely agree with the long-term perspective on the influence on the global oil market and the prices, but I think that it's the question also of that's also some of the speakers, I believe David maybe or Kingsmill mentioned in the beginning, that it will be on the and so it will be a certain balance in that. But more and probably the oil and gas companies will try to find their place in the petrochemical market. Yes, trying to invest in certain assets, but that's not easy as it looks. It may look, and I believe that all the things that's been happening with the petrochemical market, the polymer producers, especially with the ESG agenda, not about the disclosing, but about the changing your business model. That's also a sort of a barrier to just for oil and gas companies just easily come like that to a petrochemical industry. It could be so. It's very interesting to see how that will be evolved, but more stringent regulation in terms of plastic pollution, in terms of using the recycling material in packaging, in terms of recycling almost 100% of packaging that being produced and consumed in the European Union, for example. So this will also affect the appetite of those who would like to go into petrochemicals. So I'm most likely agree this is more of a long-term influence rather than short-term and mid-term. But it will be interesting to see, and it definitely makes all existing players to run even faster. Just if you want to stay where you are, you should run. If you want to run, you should run 2 times faster. That's interesting. That's a great competitive challenge for the existing players. But for us as a company, so we are buying the feedstock. I mentioned that before. We are buying feedstock on the market. So the competitive prices on the feedstock in our way of diversifying that could contribute to what will happen in the next 10 years, I believe.
Thank you, Maxim. Mikhail?
Thank you for that. I mean, there might just as well be a spike in oil prices in the short term, but as has always been the case with MOL Group, the nature of our integrated business model means we're quite resilient to any movement in oil prices. In that sense, whether it's high oil prices, low refinery margins, or the other way around, there's a natural hedge to it. So in either way, we've been quite resilient, and our earnings have been quite stable. In that sense, now in our capital markets presentation, we did come out and say that over the next 5 years, we do our premises or our key macro assumptions for the Brent crude is somewhat lower than we have previously said, at around $40 to $60 a barrel in that sense. So yes, we are forecasting a bit of a lower oil price than we've had in the past. Also, as we decarbonize the economy, but also as we move into different sectors, it will be less of an issue in that sense. As we expand, say, in other areas such as recycling, e-mobility, hydrogen, and/or chemicals.
Thank you, Mikhail. So there we go. The conclusive evidence from this panel is that we're heading into a lower oil price environment. Now, thank you very much, everybody, for participating in this discussion. I think what is left for me to do is just to thank our panelists, Natasha, Kingsmill, David, Maxim, Mikhail. Thank you very much. And also thank you very much to the viewers who are watching this panel online. Thank you and goodbye.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies.
Good afternoon and welcome to our roundtable discussion on what it takes to be a successful ESG story in emerging markets. Now, according to our calculations, around 6% of emerging market assets are already run under some kind of ESG mandate, and that share has more than doubled since the end of 2019. But we think that actually misses the point somewhat, because what we're seeing now is that more and more non-ESG dedicated investors are gradually adopting ESG policies into their investment processes. Now, ESG is very often dominated by the climate debate, emissions, and the carbon transition, and this tends to get very technical very quickly. So if you want to learn more about that, I could suggest that you watch the previous panel, which is available on our YouTube channel, which goes into that in a lot of detail. In this session, we wanted to escape a little bit from the carbon debate and showcase some of the more successful ESG stories outside of the energy and commodity space. So Tinkoff, Russia's most successful and innovative financial services. Maybe you could set the scene by running through some of the main types of ESG investing for us.
Sure. Hi, Daniel. Thanks for having me, and a great question to kick off. So yes, there is still a lot of confusion in the market. We actually refer to it as responsible investing. And the main difference between ESG, sustainable, and impact investing is that a sustainable company seeks to do no harm by practically taking into account all of the material ESG factors in order to maximize long-term value. Impact investing goes one step beyond in that it purposely targets companies that have quantifiable outcomes and positive impact, whether it's social or environmental, in addition to financial gains. So whereas an impact company can be a sustainable company as well, vice versa is not the case, because you need to quantify the impact. And what it means in terms of investment with ESGs, it's very easy to run a kind of exclusionary based quant product. But if you're a sustainable or impact investor, it's definitely the domain of the active funds, given how many different factors you need to take into account.
Okay, so moving over to Manjit. At Helios Towers, you're operating across a very wide range of African geographies. Now, I know that ESG has been quite an important part of your strategy since actually long before your IPO. What is your approach here? Is it something that you're doing to attract more investors and bring down your cost of capital? Or is it something kind of core to your business that helps you anchor your values as a company when you're setting out your strategy?
Thanks, Daniel. Yes, absolutely. So just a bit of a background into terms of who we are. So Helios Towers is an independent tower company operating across multiple jurisdictions in Africa. And effectively what we do is we build or buy towers to which mobile network operators put on their antenna so that we can provide 2G, 3G, 4G, and hopefully one day 5G signal to a wide variety of people and populations. So our business innately has quite a developmental focus because we're effectively building out the infrastructure to which people can get mobile telephony. And as we know, mobile actually hits all the UN Sustainable Development Goals. So to some extent, we innately have a developmental factor to our business and a strong ESG leaning. However, ESG is more than just having your innate business. It actually is about what else you can do. And as a company that operates in some challenging markets, we have a big impetus on good governance. We make sure that we've got the processes and systems in place to ensure that we can operate as effectively as possible. We also have a very strong social leaning. We've always wanted to ensure that the staff that we utilise very closely correlates to the communities that they serve. And so we have a 100% African employee base in the operating markets, which we think is very, very important and something which we will continue to do going forward. And then there's the E part, which is the environmental, which has always been a big focus of ours. The actual innate business model, again, of a tower company actually reduces the need for duplicate infrastructure, thereby reducing the need for duplicate generators, producing duplicate carbon, and all of the other benefits that has. But again, there's other things that we can do to try and improve our overall power generation so that we're able to provide good, reliable telecoms to the end consumer. And this has always been part of our business. This has always been what we focused on. And that's principally been driven by the fact that some of our first investors were development finance institutions like the IFC. We've also had Albright Capital as part of our overall mix and some other big private equity firms who have actually all had a strong leaning on this. So from day one, this has always been ingrained within us. What we've done since we've been listed, which was in the back end of 2019, was have to rethink how we communicate that, because effectively, when you run a private company, a lot of this can just be discussed between the few shareholders that you have. When you become public, it becomes a far differing ballgame, and you have to
trying to look at the UN Sustainable Development Goals and seeing where you can align better with them, or are you looking at the things that which have the biggest impact on, or that you can have as a company, or how do you prioritize?
I think first and foremost, we are there to try and expand the development of mobile. That is the underlying fundamental of this business, and the way in which we do that is by building more sites or adding more people onto our towers. So that is what really drives the business on a fundamental level. Mm-hmm. And then we look below that, which is actually then about, well, how do we reduce our environmental impact? Can we use things like solar, hybrid? Reduce our environmental impact? Can we use things like solar, hybrid? And actually, with our business model, if we're able to reduce the amount of carbon, reduce the amount of fuel that we're using, it actually helps us both on the EBITDA perspective, but also makes us more sustainable as well. So that then also feeds in. And then it comes down to, after that, how else can we look at alternatives such that we align to what investors and what we feel is important in the overall value chain.
Okay, and your most recent development there, I guess, is publishing your sustainable business report in March last month. Mm-hmm. How did that go? Was that quite a challenge? Was it easy to do? Was it difficult to bring everything together on in a single report? How was it?
Yeah, it was a very interesting process. I would say that in some facets it is challenging, because the moment you put something into print, the moment you put something out to the investor community and to the community more broadly, because it's not just investors, it's all stakeholders who will be interested in this report and our reports more generally, you have to ensure that there is enough certainty and assurance in the numbers that you're putting out. And whilst on a financial perspective, that's exactly what we do with our audited numbers. When you're looking at ESG-based statistics, you don't often have that. So you have to make sure that you are very, very secure in your reporting that you're putting out. And I think that took a fair bit of time. Just to make sure that we felt fully comfortable with what we were putting out into the market. I think it also came down to really taking time to understand all of the different stakeholders that we have in the business. Again, not just investors, employees, communities, and other people, what they thought of as being material for this business, and making sure that we were addressing all of those, because investors only have one part of this, it's everyone else as well. And that takes time. So I think together, it took a fair bit of time and effort to make sure that what we put out was well thought through, but also that what we were saying actually hit the key material areas. And I think in the end, we got to a pretty good point on it. There's still work to be done. One of the key things that we have to work on is our carbon targets, which we'll be doing at the back end of the year, which we can talk about later. But there's always more to be done in this space. And I think for us, what it took a fair bit of time to really appreciate was the materiality point. What is material for this business? What is within our controllables, and focus on that.
Thank you. Now, Ingrid, as an investor, how important do you find these sustainability reports? And what about standardization? When I read a set of financial statements, I know exactly how to navigate them, what I want to get out of it, and how to process the data. When I start reading sustainability reports, I get bogged down. They're all different. There's so many ESG parameters. Which ones do I look at? They're all evolving quite fast. So, year on year, the parameters are all changing. I mean, do companies need to report everything? How should they approach this? I think you're on mute, Ingrid.
To answer the first question, as Manjit said, it's very time consuming. And as such, for us as investors, these reports are very important for a couple of reasons. First of all, it shows that the company has a commitment to sustainability. There is data that you need to actually produce this report, so it means it's part of their strategy, and it gives us an insight in materiality factors that otherwise you're not going to see through P&L or your standard formatting. In terms of standardization, we are far off from standardization, and it's difficult because you're dealing with a number of different sectors. There are some metrics that can company. What should companies focus on? It's a great question, and for me, the answer is very simple. They should focus on what's important to them and where they think that they are creating value in terms of the ESG factors. So you need to be sensible about it. There is no point in trying to tick off all of the boxes, because not all of the boxes may be relevant to all of the companies. So you have to show the commitment to what is relevant to your business.
Thank you. And how about the ESG rating agencies? I mean, famously, their ratings are all over the place. When you look at credit ratings, they're all quite aligned. The ESG ratings are not aligned in any way. I mean, are they useful or not? Should companies try to target a certain sustainability score from the rating providers? Or what are the pros and cons here?
I think it's very difficult to try and actually target a certain rating. As I just said, companies should focus on what's important to them, because one is that. So I think businesses should just stick to what's important to them, and the ratings, will follow.
Okay.
I'd like to pitch in on that one, because I do agree with you, Daniel, to some extent, and I also agree with you, Ingrid. But from our perspective, when we do speak to a variety of investors, getting a rating is actually a key component part for them being able to invest, particularly for ESG and impact funds. And I think that, to the point on the credit rating piece, and where you can get some kind of standardization and an understanding of what's being put out, I think that with the amount of money that is now going into these ESG impact funds, there needs to be some kind of similar movement in the rating agencies, because it is something that is a key consideration for some investors. And certainly that has an impact in terms of the ability to which investors can then invest. To give an example, we are currently being asked to get a Sustainalytics rating. And that's proving a little bit challenging on a timing perspective. And I think that's principally because there's so many companies who are looking for this, and resource constraints, also working in the light of COVID as well, being at home. There are a few things here which are kind of coming together. So I hope that the broader rating environment does actually start to improve as well, and get the resource that it needs, so that it can actually facilitate all of this demand and all the looking that's happening at the moment on the investor community.
That they're sent. So.
And from my side, I mean, it's clearly becoming an issue, because more and more funds themselves are becoming rated on ESG. And what's happening is that various providers are taking a kind of weighted average of the ESG ratings from the rating agencies of the stocks in their portfolio. So even if those ratings are not very useful for Ingrid, they end up rating the funds themselves, maybe erroneously, but it's a fact of life at the moment. So some kind of standardization or visibility on that front would be very helpful. Okay, moving on to Neri. At Tinkoff, you published your first sustainability report almost a year ago now. Tell us a bit about what prompted that. Was it for an internal audience, for an external audience, for investors, for regulators, or to tell a story about how the firm is evolving? What was it for you?
Yeah, thanks, Daniel, and thanks again for having me on the panel. So technically, it was actually our second non-financial report, but it was the first one where we really started to gather feedback from the various stakeholders. Clearly, it started to be triggered by investors who, for the most part, as an increasing amount, have to have some kind of ESG lens through which they look at their portfolio. But then we try to already gather contributions from analyzing the priorities of our employees, of our customers, of our partners, and also of rating agencies, because although they are very different in the way they rank your business, they can give you a little bit of a nudge as to which direction you should look if you're at the starting point of your ESG journey. To us, what became clear is that we were doing already a fair bit of ESG related activities in the company, especially on the S front, because we're a financial services provider. So as Ingrid said earlier, E might not necessarily be at the top of the priorities, but on the S front, we were already doing a lot. But what we were lacking on, we were not communicating those initiatives well enough. And secondly, perhaps we needed a more strategic approach to sustainability. So this report was effectively the first step to try and address those two issues. We're at the beginning of the journey, but I think it was important to make sure that we had our commitment out there, and that investors knew that we were going to take this seriously and we were going to improve on the previous sustainability disclosures, and that we're going to continue to do so in the near future. The main audience for us at the moment is clearly the investor base. again, more and more of them are asking us to disclose more data on ESG and sustainability initiatives. But I think it's increasingly becoming a topic for other stakeholders. And we're noticing that because our employees, for example, are quite young. The average age of our employees is 26, 27 years old. They're quite socially conscious, and they want to know that they're working for a company that is doing good in the world. The central bank very recently has also started consulting with various players in the market to understand how ESG risks are embedded in strategies and embedded in risk management. So it was very important for us to start this process as early as we could, so that we have good momentum from the start, and we can make sure that we address all the needs and requirements of all our various stakeholders. We think we're in a relatively privileged position, again, that we have a strong corporate and social corporate culture. When it comes to our products and our services, we're very customer centric. We're very investor friendly. We're a progressive employer. So we think we have all the right ingredients to become a successful ESG story, but it's all to play for, and we're looking forward to continuously improving on our disclosures and practices.
Thanks, Neri. Back perhaps to Ingrid. I mean, do you have some general advice, Ingrid, on what companies should really be focusing their efforts on when it comes to ESG? I know you think it should be company by company, but in general, where should they be looking at?
Let's start with E, because it's the most popular, obviously. Well, climate change is the obvious one. What is your strategy around climate change? What kind of actions are you taking? Pollution, waste management, water management. Water management is really important. We'll look at that a lot given the scarcity. In terms of the S, obviously you have, the human capital management, the inclusion, the diversity part, but also what companies should focus on is their supply chain. What's going on in their supply chain. That is something that is quite big for us and that we put a lot of focus on, and how their supply chain is being managed, especially in terms of the labor rights as well. There is also the part to think about, in terms of the governance, the executive remuneration, the board effectiveness, but also the terms of employment for employees. Today we are operating in an economy where it's not anymore just, the full-time, the part-time. There's the contractor, there is, the freelancer, etc. What is your treatment of those type of employees as well? So it's, the benefit of all stakeholders, not just, a few chosen ones. And lastly, in terms of strategy and the risk to the business itself, what are you doing in terms of data protection, in terms of cyber security? Are you actually taking care of your operational risks? Do you have strategy in place that deals effectively with, individual operational risk that are, again, different for every business? So those are some of the broad themes. But one thing that I would point out, and especially I think it's relevant to emerging markets, is the theme of biodiversity and the natural capital preservation. I personally believe that it's even more alarming than climate action, and we're looking to see how companies are preventing the loss of biodiversity, because it's so important to the economies and to the communities.
Okay. Now, as a global fund manager, you can invest in emerging and even frontier countries and companies. How do you have to adapt your framework when you're looking at some of the emerging or frontier markets? I'm sure Manjit would agree, for many of the frontier countries, if people don't invest in them, they will never improve. So it's very important to get money flowing into these countries, but often they're starting from a lower base when it comes to some of the raw ESG scores, but in some cases improving quite rapidly. How do you think ESG investors can adapt their frameworks for that?
Frankly speaking, in terms of adaptation, you're not going to see a lot of that, because the metrics are those, and the ones that I just mentioned that are probably relevant to every business. And it's on the companies to actually improve their ESG practices and to come up with solutions internally, which obviously is not easy, especially in the frontier markets, given the size of the companies. You don't have, so many large companies with capex that they can spend on this sort of activity. So EM is lagging behind DM overall, but it's something that will need to be addressed. And we are seeing positive changes. You know, we are engaging with a number of EM companies, and we are seeing that, you know, they are on the right path in terms of the ESG. It's going to take some time, but, you know, they're making huge progress.
Mm-hmm. Okay, now back to Tinkoff. Has shedding an ESG light on your business made you change anything? Made you adapt parts of your business? Is it changing how the business is run in some ways, or is it making the discussions that you're having with some of the stakeholders, with regulator, with investors a bit easier? What are you seeing there?
Yeah, look, I think it's definitely adding a new angle to our company strategy, and we are looking to formalize in the near future what aspects of our strategy will have a more sustainable angle and message. I wouldn't say it's making the conversations easier. If anything, it's actually making the conversations more interesting, because you end up tackling topics and issues that are quite important. It forces you to think even harder about longer term risks. And I think in many respects, it actually creates a stronger relationship between the various stakeholders, because I feel like the input that you can get from investors and third parties on ESG practices and sustainable practices can often be significantly more relevant and sizable than other inputs in other parts of the business. And so we seek actively to have these conversations with our investors. And it's also helping us to decide which areas obviously have the most impact and where we should have our strategic focus. I think I agree with Ingrid that it's what's relevant to us as a company, but obviously having that input from investors and the other stakeholders also helps you to direct your efforts.
Okay, and you talked earlier about your ESG journey, which I think is probably the right word for it. And we've seen so far quite a few improvements on the corporate governance side, collapsing your dual share structure, revamping
share of female and underrepresented groups in the board. We'd like that board to also have a level of accountability over sustainability practices. So we're looking to add a sustainability or risk. Emerging risks committee, and this is all work in progress, and hopefully we'll have more news to give to investors and to the broader community over the next few months. As for the other topics, you mentioned a few right ones. So clearly for us, financial education and responsible lending are at the core of what we do. Especially as we are now the third largest bank in Russia and we have the leading retail brokerage platform, it's incredibly important for us to make sure that our customers know what they're doing and to help them out with their finances, especially as they're starting to, many of them are starting to invest and save for the first time. So we're spending a lot of time and effort on making sure that we can educate our customers. As we're a digital player and all our platforms are digital, data security and cyber security are also of paramount importance. And we have to make sure that we know what we're doing. And we're very jealous and mindful of our customers' data. So it's about putting the right checks and balances to make sure that, again, we're holding that data very tightly. And as far as I'm aware, we don't resell or provide to third parties that data. We keep it to ourselves and we keep it in very safe hands for our customers. But also we're starting to learn that actually there are areas where maybe we haven't had the focus where we want as much as we had expected. And so, for example, we did recently a survey of our customer base, and quite surprisingly, we noticed that the environmental agenda was quite important for them. And it's not necessarily something that would have flagged as crucial for us, because again, we're a digital bank. We don't have any branches. We don't lend to any large metals and mining or oil and gas companies. So for us, environmental was always something that was slightly secondary, but it actually turns out that our customers want us to do more on that front. And so now we're launching a project where we're going to be assessing our carbon footprint, our emissions, and hopefully we can be one of the companies that actually come out with quite ambitious targets as to what to do with our carbon footprint. So it's evolving all the time. And we're learning more the more people we talk to, the more we learn what's important for them, and we're trying to all formalize it into one strategy with certain priorities. Look, it's quite exciting, and it's causing a lot of interesting internal discussions, I would say.
Good. Now, Manjit, how have you found that you've had to either adapt or maybe explain your ESG approach, given the focus you have on frontier markets in Africa? Are there some things that you've had to explain to investors that are perhaps unusual or that they weren't expecting? I think you were alluding to perhaps the carbon emissions story earlier, that for Africa to develop, it will end up emitting more carbon by its very nature, perhaps before the carbon emissions go back down again. What kind of things do you have to explain which maybe are different for investors?
Yeah, I mean, look, we are coming from a lower base in the markets in which we operate, and I think that is part of the story that we have to tell. I mean, ultimately, as a business, if we want to expand and we want to try and develop mobile telephony cover, unfortunately, you don't have the grid availability to match that, either in terms of where it reaches or in terms of its reliability. So you have to use alternatives, and the point of mobile in particular is that when you are trying to provide mobile signal, you need to be able to provide it 24 hours a day. And that's not always possible with things like solar, wind, hybrid, etc. So you have to use diesel generators. And ultimately, there is at the moment a bit of a trade-off between the ability to provide more mobile, to develop the nations and use mobile as a leveler, because it is one of the greatest levelers when it comes down to development. It gives the ability for people to be engaged and to be able to link to the world. But that also comes at the short-term impact of actually having a bit more diesel utilization. And there's been a lot of research on this, and Bill Gates has even said actually that in terms of Africa, it produces 2% of the world's carbon. And you do more detriment by actually not investing in that market and not letting it develop than you would do by implementing the same structures that you have in more Western markets. I think that's a very important point to kind of bear in mind. It's certainly something which I'm talking to broader ESG and investors about, because utilizing the same matrix that you've got for other countries and other companies may not always be the best thing for the markets in which we operate. And I think a more differentiated approach is actually also useful for both how we put forward the story, but also how it's received as well. But yeah, carbon is certainly something which we're working on at the moment. We're doing a lot of work on it actually, and during the second half of the year, we'll actually put forward our carbon targets, which I'm really interested in and looking forward to kind of communicating more broadly. But ultimately, in underlying everything, we agree that we need to try and go to a net zero carbon target. It's just how do we get there, and how do we provide the level of mobile telephony that Africa deserves? Because bear in mind today, in sub-Saharan Africa, a quarter of the people still don't have mobile coverage. Only a quarter of the populations are actually using mobile, and 50% have coverage who don't even know about it. So there's a big divide, a big digital divide, and it's only going to exacerbate development. So it's important that we continue on that path.
And I think for Ingrid, this must be important for you, the whole idea of engagement and stewardship. How do you get that information from management about what's going on, that maybe there may be an increase in carbon emissions before they come down again? So I think at Federated Hermes, you've been doing that for 20 odd years now. And I think last year engaged with 1,200 companies. I mean, how important is that for both you and for the corporates?
It's very important. So in addition to 620 billion of AUM, we have another 1.3 trillion of assets under stewardship, which is practically engagement. And we represent 50 of the largest pension funds in the world, alongside focus on which are the important ESG factors, what they should be driving forward in their strategy, in their agenda. On the other hand, for us as PMs, it also helps us because we can, have a communication with the company, and we have communication on C-level, C-suite level, board level, where you can really, drive this change. And lastly, interesting what Neri was mentioning about, this is a good example about the financial company, and that their clients are, asking about environment, etc. We are a shareholder in one of the largest microfinance lenders in the world. Wonderful, impactful, sustainable business. There was just one issue with it, and that they were lending to non-sustainable palm oil producers as well as to coal companies. So we engaged with them over a number of years, and through engagement, we actually managed to stop them from getting involved in such practices. So even though it was a financial institution, we still managed to drive a positive change there. So engagement is crucial, and it helps not only clients but companies as well in knowing, where they should be focusing.
growing part of the investment universe and something that we all need to keep track of and try and get over the curve as much as possible, as I believe both the companies here, Tinkoff and Helios Towers, are, as well as you, Ingrid, as an investor. So unless there's anything else that anyone would like to talk about, I think we'll wrap it up here. And I'd like to thank you all very much indeed, Ingrid, Manjit and Neri, for your time. Thank you very much, and let's keep discussing. Bye-bye.
Thank you.
Thank you. Thanks, everyone.
Bye.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.